Ratings, dear traders, last week was relatively calm in comparison with the previous one. There were no sharp drops in the stock market, although the bearish trend persisted. Traders took notice of a significant rebound at Friday's close. It may indicate that the equity market has finally reached the bottom. And this week, speculators will access a bunch of economic reports. These macro stats may help them realize how deep the downturn in the stock market could be. Regardless of whether there are new signs of a bottom, sentiment in the equity market will depend on the Fed's aggressive tightening. Traders will have to wait for 2 or 3 rate hikes by 50 basis points before jumping to conclusions about a trend reversal. In the coming trading sessions, investors will focus on the earnings reports of the largest retailers, including Walmart and Home Depot. The US retail sales report will also be in the limelight. Watch our video review and leave your comments down below. Let's start. Market reaction to the US inflation report for April was rather controversial. On the one hand, the indicator slowed down as expected. On the other hand, it was shy of the consensus forecast in annual and monthly terms. As a result, market participants got worried that the Fed could raise the key rate by 75 basis points at the next meeting. FOMC policymakers calmed investors, even the most outspoken policy hawks. St. Louis Fed President James Bullard said on May 11 that a 0.5% rate hike is more appropriate despite soaring inflation in April. At the same time, he stressed the need to raise the rate to 3.5% by the end of the year. After encouraging comments from the FOMC members, fears of a more hawkish stance at the next meetings eased. The central bank intends to stick to 50 basis point rate increases. Judging by the dynamic in the futures market, the probability of such a scenario is 97%. Last week, traders also anticipated the publication of the Producer Price Index. However, its release did not steer the market as it showed the same results as CPI data. Consumer prices were slightly down, but the consensus reading was shy of forecasts. The report once again confirmed that inflationary pressure in the United States is rather strong. To this end, the Fed needs to take more aggressive measures. As for the main stock indexes, the weekly changes were insignificant. Nevertheless, the bearish trend prevailed. The Dow Jones dropped to 32,210 from 32,560 points. If not for Friday's rebound, the weekly decline would have been much bigger. The Dow gained almost 1.5% on May 13. It somewhat smoothed its decline. Its future trajectory will depend on fundamental factors and market sentiment. Currently, there are no positive fundamental drivers. Goldman Sachs cut its US GDP growth outlook for 2022 and 2023, saying financial conditions are tighter. GDP will expand by 2.4% this year, down from an estimate of 2.6%. Next year, the figure is likely to slip to 1.6% from 2.2%. Another bearish factor for Wall Street is the lockdowns in China. Thus, companies give more pessimistic outlooks and are careful in their comments. Lockdowns are likely to be eased by June 1. China aims to return to normal life if in the middle or at the end of June, and the local economy has already been hurt by quarantine restrictions. Industrial production contracted by 2.9% after an increase of 5% in March. Retail sales in China fell by 11.1% year-on-year after a 3.5% decline. And the pressure on the global chains is likely to extend until the restrictions are completely lifted. The S&P 500 index has been decreasing for the 6th week in a row, logging the biggest drop since 2011. The main reason is the Fed's monetary policy tightening. Last week, the index incurred small losses, falling by 30 points. Like the Dow, the S&P 500 index performed a rebound on Friday, showing an intraday increase of 2.4%. Despite the signs that inflation has reached its peak, futures, as well as market sentiment, are unable to stabilize. Consumer prices remain high, forcing the Fed to stick to a hawkish stance. Jerome Powell, who was nominated as the Fed chair for a second term last week, made rather pessimistic statements. He said that the central bank could not guarantee a soft economic landing. Powell also noted that the regulators' response to inflation was slow. Nevertheless, the Fed will continue to hike the benchmark rate by 50 basis points. He also did not rule out a 0.75-point rate increase. The S&P 500 tried to break through the support level near 3,860 points last week. As a result, it touched the resistance zone of 4,000 and 4,060 points. The next resistance level is 4,150 points. The medium-term trend for the index remains downward, with the nearest support level located at 3,860. The NASDAQ 100 index showed the biggest rebound on Friday. Its intraday increase totaled 4%. From the beginning of the year, the S&P 500 has lost 20% and the NASDAQ has declined by almost 30%. Both indexes have not hit the bottom yet. The sell-off in the stock market has been primarily triggered by the start of a Fed tightening cycle. Higher key rates boost the government bond yields. At the same time, it causes a decrease in the profits of the business sector. Technical indicators also generate bearish signals for the NASDAQ. Given the weak fundamental factors, the index is likely to retain its downward movement. It will take time before the NASDAQ composite is able to return to its previous highs, or at least get close to them. The further trajectory of the high-tech index will be determined by the pace of the monetary policy tightening and changes in the estimates of corporate profits. It will largely depend on the size of the interest rate and the pace of policy tightening. The consequences of policy tightening for the economy may also adversely affect the US stock market. As for individual stocks, Twitter shares are now in the spotlight. Elon Musk said that his Twitter takeover is temporarily on hold pending details on spam and fake accounts. However, he is still committed to the acquisition. Following this news, the company's shares fell by 10% and they tumbled by more than 20% in the pre-market. Twitter stock keeps declining as new details of the transaction have been disclosed. The price per share went below $38. Musk believes that around 20% of the accounts on Twitter are fake or spam accounts. He is also concerned that the number could be even higher than the company claims. He plans to agree on the new terms of the deal. Musk mentioned that he could even achieve an agreement on more favorable terms for him. In the United States, the earnings season continues. This week, Walmart will unveil its quarterly results, and the last earnings report was positive, although the e-commerce sector turned out to be among outsiders. More and more customers prefer online shopping, judging by the reports released by Amazon. Sales are likely to drop further in the future. Investors expect Walmart's profit to return to the highs of 2013. And that's all for now. Keep abreast of the latest market news with the InstaForex TV channel. See you soon.